Now, for the last many weeks, I've been talking about different aspects of the Iran war. As of now, it has shifted into a largely non kinetic phase. As drones and missile strikes have largely subsided, strategic discussions have centered on the Strait of Hormuz being double blockaded, with both by the IRGC as well as the United States CENTCOM, restricting maritime flows. Now, today, let's look at a more conceptual theme, something which is mostly misconstrued and miscommunicated. And here I mean the debate on de-dollarization and the petrodollar. Now, this disruption of one of the world's most critical energy choke points very much revived familiar debates around all this and the decline of the so called petrodollar system. Yet, much of this discourse remains analytically weak, overstated, historically shallow, and often detached from actual financial data. And let me tell you how. The central assumption is simplistically straightforward, and I'm sure you may have heard it several times too, which is increasing geopolitical volatility, especially attributed to Trump's unpredictability, has encouraged countries to reduce reliance on the dollar in trade and reserves. This narrative is often supported by claims of a rising petro yuan, greater gold accumulation, and a broader fragmentation of the dollar centric world. In the context of the Iran war, this argument is pushed a little bit further that Gulf countries, wary of instability in US's role, will drift away from the petrodollar system, accelerating the decline of the American monetary dominance. Now, while not all is false, it's pitched incorrectly. These claims rest on two major analytical fallacies. First, conflating de-dollarization with the petrodollar system, and second, misunderstanding how both phenomena actually function in the contemporary global economy. And let's here look at the fundamentals versus propagated myths. To begin with, de-dollarization and the petrodollar system are related but are still different concepts. De-dollarization refers broadly to the trend of reduction in the use of the US dollar in global trade, financial transactions, and reserves. By contrast, the petrodollar system specifically refers to the pricing and trading of oil in dollars and the subsequent recycling of oil revenues into dollar denominated assets. And remember, this has been one of the key powers of Pax Americana. If you look at recent data, it does not, however, support any dramatic or systemic shift away from the dollar. According to the latest IMF figures or the International Monetary Fund figures, the share of international transactions conducted in the US dollars has declined only marginally from 56.90% to 56.77% now. More importantly, the limited decline has not really translated into a surge of the Chinese yuan. The gains have instead accrued primarily to rise in other currencies, mainly the euro, followed by the Japanese yen and the pound sterling taken together. The yuan's share of global transactions has risen only marginally. The key point is that while dollar accounted for about 90% of global transactions in the 1990s, its share has fallen to about 56 to 58% bracket by 2026, and this has happened not due to yuan denominated trade, but due to euro denominated trade. The euro, which is currency of the European Union, was launched in 1999 and has ever since seen a steep increase in non-dollar trade and non-dollar foreign reserves. Now, this data I just gave you immediately complicates the narrative of a rising petro yuan displacing the dollar. Even where diversification is occurring, it is largely within the existing ecosystem of fully convertible market driven currencies, not towards a structurally constrained currency like the yuan. And I know this is a complicated point, and I'm going to return to it shortly. For now, let's visit the petrodollar and all the nostalgia around it that often leads to wrong comparisons today. The second major issue lies in how the petrodollar system itself is understood and analyzed. The conventional story traces its origin to the 70s, and it's quite familiar. Following the collapse of the Bretton Woods system, the 1973 oil shock from the Yom Kippur War, and the United States agreements, starting from Saudi Arabia in 1974 to price oil exclusively in dollars. That's the story. Other Gulf states obviously followed, leading to a system where oil revenues were recycled into US financial assets, particularly treasury securities. Now, in lieu, in exchange, which means the US became the major security provider of the Gulf. Now, while broadly accurate, this account remains incomplete. The petrodollar system itself was never really static or a monolith. By the 1980s, structural changes were underway. For instance, falling oil prices and reduced demand forced the Gulf, especially Saudi Arabia, to cut output. And that led to something significant. The large surpluses accumulated in the 1970s gave way to deficits in the 1980s. This period also saw the rise of what is known as the sovereign wealth funds, which redirected oil revenues away from traditional banking channels focused on the greenback and into global equity markets. Equally important is another point. The Gulf centric petrodollar framework cannot explain the much larger accumulation of dollar reserves in East Asia. Countries like Japan, South Korea, and even China generated massive, really massive trade surpluses with the United States in the 80s and 90s and maintained currency pegs to the dollar to sustain their own export competitiveness. These dynamics, rooted in manufacturing and trade imbalances, became far more important drivers of global dollar liquidity than just oil revenues. And this holds true despite the Asian financial crisis of 1997 or the slowing of Japan's economic miracle. So, this shift is crucial for understanding why disruptions in the oil flows today, such as those in the Strait of Hormuz, have had limited impact on the dollar's global role. Contrary to popular assumptions, there is no large or continuous outflow, so to say, of petrodollars that had sustained the dollar dominance. In fact, even prior to the current war, flows from oil exporters into liquid dollar assets were already minimal. This helps explain why the blockade of Hormuz has not weakened the dollar per se. On the contrary, the dollar denominated trade has actually increased from 49% in February this year to 51.1% in March this year, despite all the geopolitical unpredictability and blockaded Hormuz. The third persistent myth is the supposed causal link between oil pricing and dollar dominance. Now, this argument suggests that if oil was increasingly traded in non dollar currencies, the dollar's global status would collapse. A related claim is that the United States deploys military interventions to enforce the petrodollar system, and many cases are cited, such as Iraq, Libya, Venezuela, and now Iran. Now, this line of reasoning is also flawed for three reasons. First, the US has not really responded militarily to every instance of non dollar oil trade. I'll give you examples. Several Gulf countries have already entered into agreements on yuan denominated transactions, such as Saudi Arabia's 2021 deal with Sinopec and Qatar's deal with PetroChina without US military interventions. These countries continue to rely on US security guarantees, showing that geopolitical alliances are not reducible to currency arrangements only, especially when there is no alternative. Second, the global energy landscape has fundamentally changed. The United States is no longer a major oil importer dependent on Gulf supplies like it was in 70s, 80s and 90s. Since 2011, it has emerged as a net exporter of oil, peaking in 2023 and now once again after Hormuz disruptions. Now, this development significantly reduces the strategic centrality of the petrodollar system in the US policy per se. The Carter Doctrine, formulated in the period when US dependence on Middle Eastern oil was high, it operated in a different context. And third, the idea that all oil revenues are automatically recycled into US treasuries is also outdated. Gulf economies today are far more diversified in their investment strategies. For example, sovereign wealth funds allocate capital globally across equities, infrastructure, and alternative assets. Many Gulf states are now net borrowers, issuing dollar denominated bonds rather than accumulating treasuries. This reverses the traditional image of the Gulf countries as lenders of the world. A more accurate understanding of dollar dominance must therefore look beyond oil. There is another factor that I want to mention today, which is the secondary supports to the US dollar or the greenback. One critical factor is the euro dollar system, an offshore market for dollar deposits and lending that exists outside the United States regulatory jurisdiction, mainly into Europe, but not limited to Europe. This market, estimated at about $13 trillion right now, plays an important role in global finance by increasing the availability and profitability of dollar denominated assets. It allows institutions worldwide to borrow and lend in dollars without US Treasury oversight, but still with high credibility. Now, again, there are alternatives such as the offshore yuan markets, but the scale of it pales when compared because it is only about $82 billion. The structural advantages of the dollar system, deep capital markets, legal transparency, and full convertibility remain unmatched. And this brings us to the structural limitations of the yuan as a global currency. The issue is not geopolitical liking or preference for the dollar, but the institutional design per se. China maintains extensive capital controls and a managed exchange rate. The yuan is not fully convertible on the capital account, meaning that investors cannot freely move funds in and out of the country. Now, while these capital controls help Beijing maintain financial stability and prevent capital flight domestically, they fundamentally limit the yuan's attractiveness as what is referred to as a reserve currency. Moreover, China's currency is effectively pegged. First, it was tightly pegged to the dollar, and now it is pegged to a basket of currencies that are themselves closely pegged to the dollar. This arrangement supports export competitiveness but reinforces dependence on the very system China seeks to challenge. A global reserve currency requires openness, liquidity, and trust, conditions that a tightly managed financial system like yuan's cannot provide. Now, currency pegs are also widespread across the Gulf. Countries such as Saudi Arabia, the UAE, and Bahrain maintain dollar pegs precisely because they value exchange rate stability and predictability in trade. Now, this further entrenches the dollar's role in global commerce. And finally, it is important to recognize that global dollar liquidity today is driven far more by manufacturing surpluses in other regions in Asia than by oil exports in the Gulf. The 1970s model of oil driven dollar recycling is no longer the primary mechanism sustaining the system. Even in a high oil price environment, the dominant sources of offshore dollar liquidity are export oriented economies, not energy producers. And that is why next time someone says petrodollar and Iran war, you should know it's not the 1970s anymore. And to sum up, there are, of course, long term challenges. The United States now accounts for a significant share of global public debt, and this raises genuine questions about its sustainability. This has led to most economies doubling down on gold reserves. But gold's liquidity is also challenging because its storage is expensive and it works best as an emergency backup. The lesson from the Hormuz crisis is, therefore, not the decline of the dollar, but the persistence of its structural dominance, where the answer is not yuanization, and that is why it doesn't make sense for India to sign up for any BRICS currency either, for it will be a yuan dominated currency. And needless to say, I'll be back to discuss that and more. Stay tuned.